My accountant called me last week. Guy named Richard. Been doing taxes for 40 years, seen everything twice. He says, Mark, I got 3 clients this month who did Roth conversions in 2024. Smart people, engineers, a surgeon, 1 software exec. All of them just got their Medicare premium notices. One of them is paying an extra $4,000 this year. Another one, $6,000. The surgeon, almost $9,000 in IRMAA surcharges. And here's the thing that made Richard call me. Every single one of them said the exact same phrase. Nobody told me this would happen. Now, I'm looking at the data for 2026, and I'm seeing something interesting. The people who actually understand how money moves, the ones who read the boring documents, who pay attention to incentives, they're not doing Roth conversions this year. And the reason why is going to save you more money than any investment return you'll make. So here's what I'm going to walk you through today. How Roth conversions actually interact with the rest of the tax code in ways that nobody talks about. Why 2026 specifically is creating a new trap that didn't exist before. And the exact math that shows why filling up a tax bracket can still cost you 30 or 40% more than you think you're paying. Because a Roth conversion is never just a tax decision. It's a decision that touches 5 different parts of the tax code simultaneously, and most people only see one of them. Let me give you a simple model to understand what's actually happening. Think of the tax code like a series of connected buckets. You've got your income tax bracket bucket, your Medicare premium bucket, your Social Security taxation bucket, your capital gains bucket, and now in 2026, you've got this new senior deduction bucket. Most people think a Roth conversion just fills up the income tax bucket. You convert $50,000, you pay 12 or 22% tax, done. But here's what they don't tell you. All these buckets are connected. When you pour water into the income tax bucket, it doesn't just fill that one bucket. It triggers a siphon effect that starts draining water out of all the other buckets. And the amount that drains out, that's the hidden cost nobody calculates until it's too late. I want you to think about a guy named Tom. Tom's not real, but his situation is real because I've seen it 15 times in the last 3 years. Tom retires at 63. He's got about $800,000 in his 401k. He's living off savings until he turns on Social Security. And his accountant says, Tom, you're in the 12% bracket right now. This is the perfect time to do conversions. Fill up that bracket. It's free money compared to what you'll pay later when RMDs kick in. Tom thinks this makes sense. He converts $45,000, pays about $5,000 in federal tax, feels smart. Fast forward 2 years, Tom turns 65, gets on Medicare, opens his premium notice. His Medicare Part B premium isn't the standard $185 a month. It's $370 a month. His Part D drug plan isn't $40, it's $85. He calls Medicare. They tell him it's IRMA, income-related monthly adjustment amount. And what income are they looking at? His 2024 modified adjusted gross income, the year he did the conversion. Here's where the bucket metaphor comes back. Tom thought he was paying 12% to fill his income tax bucket. But that conversion caused his Medicare bucket to drain an extra $2,200 that year. His effective tax rate on that conversion wasn't 12%, it was about 17%. And he didn't know it until 2 years later when he couldn't do anything about it. But you might be thinking, okay, Mark, that's annoying, but $2,000 spread over a large conversion isn't that bad. And you'd be right, except IRMA isn't the only bucket that's draining. Let me show you the second siphon. Social Security taxation works on something called provisional income. It's one of the dumbest calculations in the tax code, but here's what matters. You take half of your Social Security benefit, add all your other taxable income, add your tax-exempt interest, and that's your provisional income. There are 2 thresholds. If you're single and your provisional income is over $25,000, up to 50% of your Social Security becomes taxable. Over $34,000, up to 85% becomes taxable. Now, here's the trap. Every dollar you convert doesn't just add $1 to your income. It can cause an additional 85 cents of Social Security to become taxable. So you convert $1 and up to $1.85 gets added to your taxable income. This is called the Social Security tax torpedo, and it can push your marginal rate from 12% to over 22% on conversions without you realizing it. There's a woman I know, let's call her Susan, retired at 62, started Social Security early because she needed the cash flow. She's got about $400,000 in her IRA. Her financial advisor tells her to convert $30,000 a year to stay in the 12% bracket. Sounds reasonable. But Susan's already getting $28,000 a year in Social Security. That puts her provisional income right in the torpedo zone. She converts $30,000. Her taxable income doesn't go up by $30,000. It goes up by about $45,000 because of how much additional Social Security becomes taxable. Her effective rate on the conversion is closer to 18% instead of 12%. And that's before we even talk about state taxes. Here's where it gets really interesting. The buckets are still draining. Let's add capital gains to this picture. Long-term capital gains have their own brackets: 0%, 15%, 20%. If you're single and your taxable income is under $48,350 in 2026, your long-term capital gains rate is 0%. Free money if you're harvesting gains strategically. But here's what most people miss. That threshold is based on total taxable income, not just the gains themselves. So let's say you're retired. You're living on $60,000 a year from your traditional IRA. You've got some stocks in a taxable brokerage account that you bought years ago. Big unrealized gains. Your taxable income is already at $60,000. You can't harvest gains at 0% because you're over the threshold. But let's say you're smarter. You retire, you stop pulling from the IRA, you live off cash for a year, your taxable income drops to $20,000. Now you've got room. You could harvest $28,000 in gains at 0%, completely tax-free. But then your advisor says, hey, you're in a low bracket. Let's do a Roth conversion. You convert $40,000, your taxable income jumps to $60,000. Now those capital gains you're gonna harvest at 0%, they're at 15%. You just added a hidden 15% tax to money you could have taken tax-free. I'm gonna tell you a quick story. A guy I know, not a client, just someone in my network, sold a business in 2023, put about $2 million into index funds in a taxable account. Retired at 59, he's got another $1 million in his 401k. Smart guy, reads a lot, he maps out a plan. He's going to live on cash for 2 years, keep his income low, harvest $100,000 a year in capital gains at 0%, rebalance his portfolio tax-free. Beautiful plan. Then he talks to a tax guy at a big firm. The tax guy says, you need to do Roth conversions now before RMDs hit. Fill up the 22% bracket. So he converts $120,000. And in doing that, he pushed himself over the capital gains threshold. The gains he harvested that year, which he planned to take at 0%, got hit with 15%. He paid $15,000 in capital gains tax that he could have avoided entirely. The conversion itself cost him $26,000 in federal tax. And 2 years later, the IRMA bill hit, another $4,000. His total cost on that conversion was $45,000. His effective rate was 37%, not 22%. Now you're asking yourself, if this is so obvious, why does everyone still recommend Roth conversions? And this is where we get into incentives. Financial advisors get paid on assets under management. Roth IRAs are assets under management. Nobody gets paid to tell you to do nothing. Tax software doesn't model IRMA 2 years out. It doesn't show you the Social Security torpedo. It shows you this year's tax bill. That's it. So people see 12% or 22% and think that's the whole cost. It's not. But here's where 2026 creates a brand new trap that didn't exist before. The so-called One Big Beautiful Bill added a senior deduction. If you're 65 or older, you get an extra $6,000 deduction. Sounds great, but it phases out. If you're single and your modified AGI is over $75,000, you start losing it. If you're married filing jointly, the phase out starts at $150,000. Let me show you how this eats into conversions. Let's say you're single, you're 66, your income before conversions is $60,000. You're at the top of the 12% bracket. You think, I'll convert $50,000 to fill up the 22% bracket. Smart move compared to future RMDs. But that conversion takes your modified AGI to $110,000. You're now $35,000 into the phase out range. The phase out works over a $50,000 range for singles. That means you lose about 70% of the $6,000 deduction. You just lost $4,200 in deductions. At a 22% marginal rate, that's about $924 in extra tax. Your effective rate on the conversion just went up by almost 2%. And again, this is before IRMA hits 2 years later. Here's a real scenario, real numbers. Guy is 67, married, filing jointly. He and his wife have $1.2 million in IRAs. Their Social Security combined is about $55,000 a year. They're living on $70,000 total, pulling $15,000 from the IRA to supplement Social Security. They're in the 12% bracket. Their advisor says convert $100,000 this year. That would take them to the top of the 22% bracket. Sounds efficient. But let's run the actual math. Their modified AGI before conversion is $70,000. After the conversion, it's $170,000. That's $20,000 into the phase out for the senior deduction. They lose about 24% of the $12,000 combined deduction. That's $2,880 in lost deductions. At 22%, that's an extra $634 in tax. The conversion also pushes more of their Social Security into taxation, adding another $2,000 in taxable income. The conversion triggers about $300 in additional tax from that. And in 2 years, when they're 69 and 71, the IRMA surcharge hits. They'll both be in the second IRMA tier. That's an extra $3,200 in Medicare premiums. The total cost of that $100,000 conversion is about $29,000. Effective rate of 29%. They thought they were paying 22. Now, 2 quick things I want to mention. First, I saw a post on a financial forum last month. Someone said their advisor told them Roth conversions are like buying insurance against future tax rates. I had to laugh. Insurance protects you from an unknown risk. Future tax rates are unknown, but you know what's not unknown? The Medicare surcharge you'll pay in 2 years. The Social Security taxation increase that happens this year. The capital gains bump. The lost deduction. Those aren't risks. Those are certainties. You're not buying insurance. You're buying a known cost today to avoid an unknown cost tomorrow. That's not insurance. That's speculation. Second, I was talking to a CPA last year. Guy works at a mid-sized firm, does a lot of retirement planning. I asked him how many of his clients who do Roth conversions actually run a full projection that includes IRMA, Social Security, taxation, capital gains interaction, everything. He said, and I'm quoting, maybe 10%. Most people just want to fill up the bracket. I asked why. He said, because modeling all of it takes 4 hours, and most clients don't want to pay for 4 hours of planning. They want a simple answer. So they get a simple answer, and then they get a complicated tax bill 2 years later. Look, here's what I want you to understand. Roth conversions are not bad. They're a tool, but they're a tool that's been over-recommended because the people recommending them don't pay the hidden costs. You do. And in 2026 specifically, with the new senior deduction phase out, the costs are higher than they've ever been for certain income ranges. So when I say smart retirees are skipping Roth conversions in 2026, I don't mean all smart retirees. I mean the ones who actually did the math and realized that paying an effective 28 or 32% rate today to avoid a possible 24% rate in 10 years is a bad trade. Now, I've spent 10 years running my own business. I've been in rooms with accountants and tax attorneys who bill $800 an hour. I've learned that the way money actually moves is nothing like what you read in a blog post or hear from a guy on TikTok. The tax code is written by people who benefit from you not understanding it. Every deduction, every credit, every phase out is designed to look simple on the surface and hide complexity underneath. And Roth conversions are the perfect example of this. The pitch is simple. Pay tax now at a low rate, grow it tax-free forever. The reality is you're paying tax now and also paying Medicare surcharges later and also increasing Social Security taxation now and also losing capital gains opportunities now and also losing deductions now. It's 5 costs, not 1. I'm going to give you 3 things to actually do with this information. First, if you're between 63 and 65 and you're planning to do conversions before Medicare, you need to model the IRMAA impact for when you turn 65. Not maybe. You need to, because the look back is 2 years. A conversion at 63 hits you at 65. A conversion at 64 hits you at 66. If you don't model this, you will get surprised. Second, if you're already taking Social Security, you need to calculate your provisional income before doing any conversion. If you're anywhere near the thresholds where more of your Social Security becomes taxable, your effective rate on the conversion is not your marginal bracket. It's your marginal bracket plus the additional Social Security tax. Run the actual numbers. And third, if you're 65 or older in 2026, you need to check if you qualify for the senior deduction and where the phase-out range is. Because losing that deduction adds about 2% to your effective conversion rate. That might not sound like a lot, but on a $100,000 conversion, it's $2,000. On $300,000 over 3 years, it's $6,000. That's real money. Here's the thing I've learned after watching hundreds of people manage retirement accounts. What 99% of people do is usually what not to do. Everyone's doing Roth conversions right now because everyone's talking about Roth conversions. The content creators talk about it, the advisors recommend it, the tax software prompts you to consider it, and because everyone's doing it, it feels safe. But the math doesn't care about what's popular. The math cares about your specific situation, your specific income, your specific Medicare timeline, your specific Social Security strategy, and your specific state tax rate. And for a lot of people in 2026, when you actually run those specific numbers, the Roth conversion that looked like a 12% cost is actually a 28% cost. And paying 28% today to maybe save 24% in 10 years is just bad arithmetic. The smartest retirees I know aren't asking, should I do a Roth conversion? They're asking, what does this conversion cost me across all 5 buckets? And is that total cost lower than what I'll pay later? Most of the time in 2026, the answer is no. And that's why they're skipping it.